Hi, Kinloch Capital investors and Kinloch Capital community. This is Peter Walls, Chief Investment Officer. Welcome to our most recent update. Today is Sunday, October 3rd. I'm recording this. I'm going to be talking about the activities that happened the previous month and also going to be adding in the activities from previous month in August, as I was not able to get an update out at the beginning of September, talking about the August month. The funny thing about that was I did receive a number of emails, a number of calls from folks saying, hey, is the update on its way? And I appreciate folks being alert to this and asking those questions. It makes me aware that you all do appreciate this and are looking for it, if not looking out for it, if not looking forward to it. And also had some folks share with me things that they'd like to see from this month, what should be a monthly and will be a monthly update. Some of the things that you all have asked from me is, appreciate the update, wondering if we can get it from a 30 to 40 minute format, maybe to a 15 or 20 minute format. And I appreciate that, want to try to get to the point, make it timely. I've even been asked if I could put out some sort of executive summary, trim it down to just a few minutes. And I'm going to try to figure out how to do that. Of course, the markets are a complicated place. And in order to try to explain not just what happened, but why it happened, or why, as your financial advisors and your money managers, we made the moves that we did. Sometimes it can take more than just a few minutes. But one of the things that I've been toying with since getting that suggestion is perhaps putting out a series or posting to our website a series of educational videos that will give you the background, or give folks the background of how we look at the markets through a fundamental lens on one of our models, through a technical analysis lens on the other three models. And folks can perhaps watch those, become familiar with some of our thoughts around how we go about investing money. And therefore, when we come to the actual updates, I don't have to keep repeating things like give details about candlestick charts and things like this, because if you'd watched the educational videos, you would already kind of know about those things, and it wouldn't perhaps make these updates go along in a more timely manner. So I'm going to take that under advisement and see if we can get to work on that in the quarter ahead. So in interest of being timely, let's go ahead and get going. The format that we're going to use should be familiar to those that have been on these calls in the past. We run 4 model portfolios, one which is referred to as Deep Blue, and then we have 3 tactical models: sector rotation, tactical balanced, American momentum. And then, as we usually do, we're going to talk a little bit either on a planning point or on an educational point, try to make you smarter in investors. And we're going to talk about seasonality in the market towards the end. So continuing on, starting off as we normally do, talking about Deep Blue dividend growth. It is a model portfolio that I think Warren Buffett would be appreciate, or if he knew how we went about managing money in this model, I think he would approve. One of his favorite sayings here: buy companies with strong histories of profitability, hold on to them forever. I said the only word here that we swap out or substitute out for the word profitability is histories of rising divs or rising dividends. We're looking for companies that have multi-decade long histories of not just paying dividends, but also increasing those dividends. In September and October, we had an additional 4 companies from our Deep Blue dividend growth strategy continue to pay and raise their dividends. 2 of these companies are related, Altria and Philip Morris. Those used to be the same company, but back, a decade and a half ago or so, split off into two different companies, basically a US-based company and an international-based company. Both of these companies raised their dividends by healthy amounts, 4.7%, a little bit more than 4% here. And you can see very long history, 52 years in a row of dividend increases. Federal Realty, which is a REIT, a real estate investment trust, they are a company who's in the business of buying, selling, and managing real estate. This is the 54th consecutive year of increases for Federal Realty. Relatively small increase for them this year, although REITs in and of themselves pay higher than or much higher than normal dividends anyway. So to have we have perhaps a smaller increase, but off a relatively high base. And if anybody, Federal Realty may own other properties in the greater Virginia area, but one that I know that they own is Willow Lawn. So if you've been over to Willow Lawn anytime in the last 4 or 5 years, you know that the space has gone through dramatic changes in order to turn it from probably in one of these interior malls whose better days perhaps had been seen, to now it's quite a thriving little area. And that's the kind of work that Federal Realty does. And finally, a name that I know everyone knows, McDonald's, a very, very nice dividend increase this year, 7% increase, the 45th consecutive year that they have increased their dividends. So the stocks that we own in order to for dividend increases continue to perform as we expect them to. In terms of looking at our other models, our tactical models, by tactical I mean that when market conditions change, we make changes to the asset allocation, the mix of stocks and bonds inside the portfolio. So in order to know the changes that we're going to make, we need to take a look and see what the market is actually doing. We typically start out here with a very, very long run view of the market. This is going back to 1998, which I've made reference to was my first year in the industry, going back more than 20 years. And what the market has done since I've gotten involved in the financial business is all on this single screen here. And we read the chart as we do a book, left to right. And we see that most recently, if you see my cursor in the upper left-hand side, the most recent market action in the month of September is right there. So I'm going to zoom in here so we can get a better look at what's going on. We want to keep in mind what the long-term history is, but we also need to be aware of what's going on in the shorter term. And so now I'm going to zoom in from basically this kind of time frame right here. Basically look at the last 3 years or so, is then recreated or blown up on this particular page right now. So if you've looked at the market or you've opened or received or looked at your statement, you know that last month, the month of September, was a down month for the market. I can tell that because this candle is red. And so I know that the market started the month there and finished the month there. And so we finished down for the month. However, this is the first down month in, I think, more than or about 7 months. Here are the previous months going back in time, and we've got to go all the way back to January. When actually we had a down January, but February, March, April, May, June, July, and August all were up. So question is, being that we had this decline in the month of September, do we need to be concerned to the point that we should be changing our overall asset allocation? Do we need to do anything differently? Is this overly concerning? This is, in fact, the computer has put in the figures here for us. The high for the month was S&P 4545, and we finished the month at S&P 4307. So if you get your calculator out and do the math, it's about a 5% decline in the market. Is a 5% decline something that we should be concerned about? And in our methodology, it's not so much that whether or not 5% is a big decline or a small decline. The question in our mind is, did that interrupt the long-term uptrend that we have been in? And the way that we're going to evaluate that is that we're going to look at where the market finished last month in comparison to its long-run moving average. So the market finished last month here at 4307. Okay, we see that there. But the long-run moving average is here at 4113. In fact, the long-run average for September is there. For the month prior, for August, is there. The month prior, the month prior, the month prior. And if I put these together in a line, okay, I'd see that the S&P here is still above its long run moving average. So the trend, I'm going to make the point, is still positive, even after a 5% pullback. So trend is in our favor, and we're going to get a check mark there. And while I can see where momentum was in the month of August and where momentum finished the market in September, I can see that momentum fell. Okay, we're still positive. We're well above this zero line. So momentum is positive, and so it gets a check mark. So despite the 5% pullback in the market, and that we are not going to do anything to change our asset allocation, we're going to remain in growth mode, just as we have been for many, many months. In fact, I've got to go back to here. Let's grab the pen. We got to go back to the summer. Oh, pardon me. We got to go back to the summer of last year, where we started this new uptrend. So, and we can see several other times. Here is a down month, but we remained above trend. I mentioned last January was a down month, but we still remained above trend. What would this be? December, November. Here's October and September of last year, both down months, but both remained above trend. So this, if I were to draw kind of a channel here, that's when you draw a trend line above and below the market's action. You can see that this channel is still fairly intact, even though the market's come down some. So we're going to remain with our growth allocation, more heavily tilted towards stocks than bonds and cash. As we've spoken before, we are a little bit more aggressive if you are a listener or an investor who's under 59.5 and still has maybe some years to go before retirement. If you are closer to 59.5 or in retirement, we hedge that out a little bit and leave a little bit in bonds and cash, even if all systems continue to be go. In terms of American momentum, our third tactical model, this model takes 26 different American funds from the American Funds Fund family, and we own at any one point in time essentially the top 5 names in equal shares, and the top 5 funds from last month are the same top 5 funds from this month, meaning the trends that were in place last month continue to be the same trends that are in place this month. So no need to make any changes there. So in terms of if you were to go and look at your account either on a statement or go and look online at your current holdings, redone this a little bit to try to give folks an idea. Here in sector rotation, there are 11 sectors that make up the S&P 500. People or the media often talks about how the market is doing. In fact, I just talked about it right back here, that the market, since rebounding after the COVID crash, has more or less been in a pretty steady uptrend and a nice, healthy channel for more than a year now. But the market did pull back about 5% this year. The market, though, is made up of a number of different sectors. That's the idea behind sector rotation. Those sectors which are currently, by the way, there is a listing of the 11 different sectors. The ones that I have put in bold and underlined are the ones that are currently represented in the portfolio by our measure in terms of relative strength and trend. This is where the best action is occurring, or in those sectors. So we have positions in those sectors. We do not own the sectors that are not emboldened and highlighted there. For tactical balance, we continue to be heavily tilted towards S&P 500. And of course, we've talked about American momentum there and the fact that these are the 5 funds represented in the portfolio of the 26 different ones that are offered by the company. These appear to be the ones that are behaving best right now. Hence, those are the ones that are in the portfolio. Kind of in closing, monthly planning point. Just a moment to talk about seasonality, because while a 5% pullback in the market is a fairly modest pullback, it's not necessarily fun to go through. I have money in the market as well in these same models. So no, I don't like to look at my account and watch it go down, even if by a moderate amount. But I know that I've got to be willing to accept some volatility in return for this kind of growth over the last year and a half. But in terms of the market being down in the month of September, I would tell you that that's not necessarily that unusual. In fact, we just pointed out here that in September and October of last year, the market was down. And in fact, when you study this stuff, this is some results over about the last 50 or so years that show each month of the year and then what the average return of the market is by that month. So what you see here is that we were down in September, but that's not terribly unusual. In fact, September is historically the single worst month of the year. October, interestingly, probably has the worst reputation because the crash of '87 happened in October. The crash of 1929 happened in October. So again, difference between reputation and reality. Reputationally, October has the worst reputation, but it's actually August and September tend to be the months that are down. So in any case, we've got to get through the next few months. Seasonally, the best 3 months or the best quarter of the year is still coming up. It tends to be November, December, and into the following January. These 3 months, 1, 2, and coming around to the beginning. If you look at that chart, you don't see 3 lines together in terms of calendar quarter that tend to be any better than those. So while the market is off this month, and we may have to get through October, I do expect that by the end of the year, meaning November, December, those historically are very good months for the market, both a high propensity to be up and then also tend to be up much stronger than other months of the year. So it would not surprise me if we finished the year up here, certainly a great deal higher than we are today. So in effort of trying to keep this brief, that is going to be the remarks that I'm going to make for this month. But as always, if you have questions about what was presented today, or questions about your portfolio or anything else, please do not hesitate to reach out to us by phone or by email. We're happy to chat with you. That's why we're here. And wish everybody a good day, and we'll talk to you next month, if not before. Thank you.